Welcome to Thoughts on Investing. Today, we are deconstructing a massive market event, the 400% reversal of Intel stock over the past year. Before we dive in, please note this video is for educational purposes only and does not constitute financial advice. For much of the early 2020s, the market labeled Intel a value trap. The company suffered from delayed process nodes and steadily lost ground in the CPU market to competitors like advanced micro devices. At the exact same time, the artificial intelligence accelerator wave arrived. Nvidia dominated that high-performance hardware space, leaving Intel looking completely outpaced. Yet, over the last 12 months, Intel stock defied intense institutional skepticism, surging 400%. This move is not driven by the release of a single new product. The market has completely reversed its narrative, reclassifying a struggling incumbent as a necessary pillar for future AI infrastructure. To understand this shift, we have to look at industrial strategy, direct government intervention, specifically policies associated with Donald Trump, and broader U.S. CHIPS Act initiatives altered the company's risk profile. These policies channeled significant financial backing and equity participation directly into Intel's operations. For institutional investors, this backing provided ultimate downside protection. It signaled the company is considered too strategic to fail. With that safety net in place, the massive financial risk of building new fabrication plants is offset, severely lowering the long-term cost of capital. State intervention effectively turned Intel into a proxy for U.S. semiconductor independence. That safety allowed capital allocators to stop treating it as a struggling tech firm and start treating it as a long-duration infrastructure asset. Beyond geopolitics, there is a widespread market misconception that Nvidia is the sole financial beneficiary of the AI supercycle. The reality of data centers is that AI workloads require a full compute stack. Intel's server processors serve as the critical orchestrators for nearly every major deployment. Even when a server rack relies on Nvidia GPUs for the heavy lifting of AI training, Intel CPUs are almost always sitting right alongside them, managing the broader system. These platforms are highly interdependent. The immense memory requirements of AI drive massive demand from ecosystem partners like Micron and SK Hynix, and Intel's hardware integrates tightly with those memory systems. As hyperscalers and enterprises poured billions into global AI investment, Intel's hidden structural role drove a recovery in its data center revenue. That real financial growth provided the fundamental validation to sustain the stock's massive rally. Then there is the company's most ambitious operational pivot, Intel Foundry Services. Historically, they designed and manufactured chips exclusively in-house. Now, they are opening their highly guarded fabrication plants to external customers. This transition pits them directly against contract manufacturing giants like Taiwan Semiconductor Manufacturing Company. This bar chart demonstrates Intel's original internal total addressable market expanding outward to encompass the much larger global contract manufacturing market. By transitioning into a platform company, they drastically increase their potential revenue base. Speculative rumors have acted as powerful narrative accelerants here. Discussions about potentially securing Apple, one of the world's most demanding chip customers, as a massive foundry client, quickly shift market expectations. If this ambitious foundry bet succeeds, Intel effectively centralizes a massive portion of the global semiconductor supply chain. The current stock price reflects future industry dominance, rather than the reality of their business today. The final driver of this rally involves capital flows. When the AI boom began, money flooded into early winners, stretching their valuations to extreme highs. As those trades became crowded, institutional investors aggressively searched the market for lagging beneficiaries that still had room to grow. Intel possessed the perfect criteria for this rotation: a large market cap, clear exposure to AI, and explicit state backing. Money rotated out of the expensive early winners and into Intel as a catch-up trade. That momentum fed on itself, turbocharging the stock price far beyond what the immediate fundamentals alone could justify. Today, the market officially prices Intel as a full-stack, nationally strategic AI infrastructure provider. But it is crucial to recognize that this valuation is built heavily on expectations of future success, rather than current profitability. The structural risks are severe. The new foundry business requires tens of billions of dollars in capital expenditure and is currently operating at a massive loss. while competitors like TSMC still maintain strong technological leads. This entire narrative hinges on product execution. To sustain this valuation, the company must close the technological gap with their upcoming 18A manufacturing node. If that technological execution stalls, the 400% surge will prove incredibly fragile. The current price represents a massive expansion of market expectations that can violently reverse. Intel's incredible 400% surge is the result of a rare convergence, a geopolitical necessity, a massive technological transition in AI, and a targeted institutional capital rotation. The market has placed a high-stakes gamble on the strategic necessity of semiconductor independence. Now, the company simply must execute. Thank you for watching Thoughts on Investing. Please like this video and subscribe to the channel for more market analysis.